All right, good morning, Facebook friends. It's good to see you. This is Mark Prather here with Mark One Mortgage, Mark One Wealth Academy. I'm here with a good friend, John Jackson, who's a CPA. And today we're going to be talking about the new tax reform bill and the changes and how it's going to impact our economy, the opportunities it creates for you, and hopefully, these opportunities are there, and that's the whole point of this program. You can see on our PowerPoint, this is the cover of my book, the title, Why the Rich Stay Rich and the Poor Stay Poor. I'm sharing that because I want to share today is a perfect example of why I titled the book this. Is Why the Rich Stay Rich and the Poor Stay Poor is 90% of the people never change their life circumstance. There are two key reasons. The number one reason is what they believe. Most people don't believe it's possible to change their life circumstance, so they don't. The rich stay rich, the middle class stay middle class, and the poor stay poor. Because of that belief system, they don't extend and make the effort. The second reason is what we know. And the truth of the matter is, the rich have far greater access to information than the average person. I've lived this in my personal life. When I was a kid growing up, neither one of my parents had high school diplomas. All my relatives didn't have high school diplomas. And so in our home, we didn't have well-educated parents, that were knowledgeable in law, accounting, business, or whatever. And so there's nothing better than having a parent that is well educated in these different areas. But I'll tell you the other advantage, and that my children have had that I didn't have, and why I titled the book this, is that if my children had a question, and this really started happening as they started becoming teenagers and even through college, if I didn't know the answer, I knew who to call. I had professionals, guys like John, whether they were CPAs. I've got a number of attorney friends that have specialties from trusts to different types of real estate law and so on, and beyond, and various business owners that I built relationships with. So my access to information was far greater than which I could pass along to my kids, than the information that I had access to. Didn't know who to call. People I knew didn't really know anything, and so it was a totally different experience. My point is, life's not fair. It just isn't. That's just the way it is. And why we created the Wealth Academy is to try to level the field a little bit better and make this kind of information accessible to everyone at no cost. So we're going to get into this Tax Reform Act because in my view, it is a major game changer. I'm going to share a little bit, and then I want to get John's perspective on this, and we're going to talk a little bit about this as far as the impact of the Tax and Jobs Act. Before this bill passed, let's just kind of look at the landscape, and let's assume this didn't happen and where we are. The number one question that we get asked, and I say we are, that consumers are asking realtors, loan officers, people in the real estate industry, is this another bubble? Our price is going to drop significantly. The 2008 meltdown, it's been 10 years. Over the last about 7 or 8 years, we've seen property values steadily rise. In Orange County, they've averaged about 8.5%. Chasen and I were analyzing one of his clients. In the last 7 years, his condo in Fullerton has averaged 10.5% appreciation over the last 7 years. Pretty incredible numbers. So the question is this a bubble? It's a legitimate concern and a legitimate question. The affordability index is at a very low level. In Orange County, it's about 20% of the people can afford a medium price home. I like to look at the affordability index as in fact, in my view, it's the number one indicator that I follow to track the market. I like to look at the affordability index like a rubber band, where when you look at what people's incomes are, what costs are, and that affordability index can only stretch so far, and you start to reach a limit. And that is something that is why we're getting that question from so many people of, are we in a bubble? Because they see what's happened. This tax cut, Jobs Act, I think is an absolute game changer. Here's why. There's only two ways to help affordability. Only two. One is what we saw before, which is make things cheaper. How do you make things more affordable? How do you make them cheaper? Well, either one, you cut the prices, or two, you cut interest rates. Well, interest rates aren't going down. They've gone down. They're starting to move their way back up. Goldman Sachs, I just read in one of the reports, I get a Goldman Sachs report every week. I think it was last week in the report. They're projecting 4 increases this year and 4 next year. Okay, so that's 2018, 2019. So not going to happen in rates. So there's the price point, but here's the other factor. The other big factor is income. Without this bill, if we look at what's happened to payroll increases, there have been basically, for about the last 16 years, payroll has been flatlined. So we've seen this big run up, but we haven't seen payroll increases until now. And this year, we start to see that we're finally starting to see these facts. And so these are some of the things that when I asked John to get his input. So John, when we talk about this first one is the repatriation tax and why that's relevant for everyone.
Well, what's happening is these U.S. companies that have significant monies overseas are going to have an incentive to bring it back into the United States.
How does that incentive work?
Well, because of the fact that the old law, they would have to pay 35% when they brought the money back, and the new law allows them to bring it back at 15.5%.
Okay.
So what a significant lower rate that is for them to bring the money back and have lower taxation. So the time is now. It's been 35% a long time. So all of a sudden it's 15.5. They are now going to want to bring that money back, pay the tax, and they'll have a lot of excess money to invest into new businesses, new development.
Okay.
Hopefully new jobs. I mean, I think the purpose of it is to get the money back in the United States and generate job growth.
Right. Well, I'm looking at these numbers. Cisco 67 billion, Apple 250 billion, and this is just a couple. U.S. companies have 2.6 trillion dollars overseas. I mean, that's staggering.
It is.
I mean, have you read anything about of that 2.6 trillion dollars? Have you seen or heard anything about what percentage of that people are thinking that it's going to be coming back into the States?
We don't know exact percentage, but there's going to be a big incentive to bring it back, given the new lower rate.
Yeah.
So we'll see. Apple's made announcements. Cisco made announcements. So we've got we'll have to wait and see.
Yeah. Well, so this is just the start of it, but you can see these kind of dollars. I mean, think of that $2.6 trillion that has been offshore, and what this gets down to is bottom line is businesses are in business to make money, so they're going to do whatever they can that's going to benefit them. And now when the rules get changed, $2.6 trillion start to bring this in. What are they going to, if they bring this money back, they're not going to just put it in a bank account making zero. They're going to reinvest this money in ways that they can make money. Now let's get into the next thing. Explain about the 100% expense.
Well, we currently the new code allows us to do bonus depreciation, which is 100% expensing. So if you bought a $1 million piece of equipment worth $1 million, you'd be able to expense that equipment. So there's no limitations on expensing for most equipment out there. So there's going to be an incentive out there for businesses to, if they want to expand, expand their operations, buy new equipment. They can buy that new equipment and expense it right away, get the immediate tax write-off. So there is going to be more economic activity because the tax law has now allowed us to expense this equipment.
Now, let me elaborate on what John's saying, because I've lived this over my career firsthand and why this is huge. I'll give you an example. I've been a small business owner pretty much my whole life. Let's say I want to buy a photocopier. And I want to buy a $10,000 photocopier. All right, now, to buy that $10,000 photocopier, I write a check for $10,000. previously, what
Well,
happened?
previously we had $500,000 to deduct. So we've always been able to expense up to $500,000. But now we can actually exceed the $500,000 mark. So you're going to have people who maybe want to buy an airplane. They can expense the airplane if it's less than 20, has a life of less than 20 years.
But, but as far as like how,
and it's new and used equipment, and this law is special because you could actually take a loss if a business wanted to expand and lose money to potentially grow in the future. They get to deduct the loss with it on their tax return.
But when now, and I don't want to make it too confusing.
Yeah.
But with respect to when you're talking about dealing with with cash write-offs versus the accrual write-offs and that, does this?
No, it doesn't matter fact whether it's cash or accrual, whether you pay for it cash wise or whether you incur debt, you still get this deduction.
Okay, all right. So so the big benefit for the business is that you don't want to write big expenses because when you pay this, if you cannot expense all of it, then you're going to basically pay tax on money that you don't have, right? Because because you've spent the money, but you can't write all of it off. So you still have to pay tax on, or you did.
Yeah. There's a timing difference here.
Yeah.
But this new law is more about for companies, I think, that maybe have excess cash and they want to buy equipment and lower their taxes, and it just gives them the incentive to make that equipment purchase because they're going to get lower taxes from it, which they can reinvest in other ways.
Okay, all right, and then it's the last one, 20% OBI deduction result in tax savings will be invested. That's what we're going to get into, right?
Yeah, we're going to get into that new law.
Okay, all right. Now, here are some of the changes if you're not familiar with these, and we're not going to spend a lot of time analyzing this, but just, and you can obviously access this online pretty much anywhere. But if you look at, the different rates, for the prior law, the 10, 15, 25, 28, 33, 35, and 39.6. And you can see, the reductions. Now, this is the single filer pretty much all the way down. Now, we have the married filing jointly, and you can see, the tax cuts pretty much, lower pretty much all the way down across the board. Have you done a study or seen anything as far as what percentage of Americans are going to see their taxes drop? Because I've heard that there are some people that, for whatever reason, because to me, when I look at this, it looks like everybody. But
yeah, it does, doesn't it? I mean, you got a 28% bracket going to 24%. That's a nice bracket there that's going down.
Yeah.
So the study, I think we're going to have to go through the process to see eventually if everybody's going to get tax reduction here, because there's so many things we have to juggle. But that's a good point there. Those are lower rates. So I would anticipate everybody's going to get a benefit from the law. Okay,
great. All right. Then the standard deductions. So John, I'll just let you explain the standard deductions and the changes and how this is significant.
Well, the standard deduction used to be what it is now. What's great about it now is that if you're a joint, let's say you have a joint return, you'll get $24,000. You'll get a $24,000 deduction regardless if you have mortgage interest or charity or state taxes. So, and in a lot of cases, that might be more than what people had originally. Right. So if somebody didn't have a lot of mortgage, didn't have a lot of state taxes, didn't have a lot of charity, and they were below that $24,000, now they get $24,000.
Yeah.
So that could be a win for a lot of people.
So,
actually, people who don't own homes, it's actually helpful for people who don't own homes too. So,
well, I was just saying, the real world, with the clients you're working with, how much of a benefit, or when I say how many people as a percentage, or do you think are going to benefit from this?
A lot of people.
Okay.
I would say, it could be half the filers out there.
Okay. All right. Yeah. Well, because the numbers doubled. So
yeah, it's double. Right? Yeah. So that's huge. I like that.
Okay. All right. Repeal of personal and dependent exemption to prior law. Tax filers could deduct $41.50 for the filer and his or her spouse. So, how is this relevant to people?
Well, it gets phased out. So that's a little bit of a negative to certain people. Yeah.
Okay. All right. Next, child tax credits doubled and extended to higher income. So tell us about this a little bit.
This is great. We got we're going to get doubled. The tax credit's going to go from $1,000 to $2,000 per child, And what I like about this is that they really upped the limitations. Before, if you made more than $55,000 as a single taxpayer, you wouldn't get your child care credit. But now they've actually doubled up to $200,000 for single filers and $400,000 for joint filers. So now you're most likely everybody's going to be able to get the child care credit, and it won't be phased out.
Right. Okay. All right. Terrific. Terrific. Okay. All right. The mortgage interest deduction. Now, this has created quite a stir in the real estate world. Particularly, in California, when you can see on the mortgage interest deduction on new loans after December 14th of last year is limited to $750,000. So, in California, higher cost state, there are a lot of properties above. In fact, I believe in Orange County the median price is around the $750,000 neighborhood, $750,000 neighborhood. So there's a lot of properties that are north of that, and if you're looking at $1 million property and someone puts 20% down, that's an $800,000. So they're not going to be able to deduct all of that.
They won't.
Right?
Yeah, they won't. No.
Yeah, so they can deduct at that limit. And this really irritated the California Association of Realtors. CAR, and then in New York was the other big state that was really pushing back on this. And I'm going to share with you as we get into the presentation some of the trade-offs that happens in Congress, when you have the negotiating process of trying to make everybody happy. But let's see, mortgage interest deduction on current loans that are in this. So there's loans. The previous mortgage interest deduction was $1 million, so they're still grandfathered in. Mortgage interest deduction on second homes is retained, subject to the same limit. Mortgage interest deduction on refinance is retained as long as new loan does not exceed the mortgage being refinanced. And then the mortgage interest deduction on home equity debt, unless proceeds are used to substantially. So no mortgage insurance deduction or mortgage interest deduction. So that says it's.
Yeah, they took out the home equity debt. So
Yeah.
It used to be we could actually take, I think, up to $100,000 of deduction on home equity debt. And that's no longer in the law.
Well, it says unless proceeds are used to substantially improve the property.
Yeah, that would be true. But it would have to improve the property, but it wouldn't be able to exceed the $750,000
Right. Or
max. Yeah.
Okay, so it has to be within that confines.
Yeah.
And then if someone has made an improvement, like let's say they remodeled their kitchen, so they got to bring in all the proof of that to you to.
Yeah,
Okay.
definitely.
Yeah. Okay. All right. So this limit, this $750,000 mortgage interest deduction, I said that's one of the things that CAR and California Association really were not high on. All right. Now the next, state and local tax capped at $10,000. So I'll let John explain a little bit about how this state and local tax cap works.
Well, yeah. Well, now it's capped at $10,000 total for property taxes, income taxes, and sales taxes.
Yeah.
And that is a negative for California
Yeah.
because we have expensive homes here.
So what percentage of the people do you think will be affected by this?
In California, in my practice, a lot. Yeah, definitely in my practice, a lot because they have larger homes and they pay interest.
Yeah.
So I mean, they have bigger homes, so they pay a lot in property taxes. So it's going to affect, and that's the negative in this whole transaction. Is the fact we can't deduct state taxes.
Okay, well let's take on state income taxes. Okay, what would you say the income level is to where when you hit the $10,000 just on state income taxes then?
Well, on state income taxes, that takes a lot for $10,000 for most people.
So is that
the average taxpayer could be less than that, much less than that.
But at $100,000, because I know it tiers up,
right?
On state income tax. If someone has $100,000 in taxable income, do you know what their effective tax rate, state income tax rate is?
On the state, no, I don't know.
Okay.
Without looking at a chart.
Yeah, because I know the chart goes like 5, 6, 7, 8, 9. I think it caps at 9, doesn't it?
No, it caps at 13.3%.
On the state level?
Yeah.
Okay.
So if you make over $1 million a year, you're paying 13.3% state taxes, which used to be a great benefit for when we didn't have this law. You could deduct that 13.3%, which would bring the effective cost of your state taxes down.
Right. Okay.
But now we don't get to deduct it when it exceeds $10,000. So you got that's a big negative for wealthy. Our business owners, that's a negative in California.
Well, just kind of looking at that 10,000 limit, so it seems to me if someone's earning, let's say, in excess of about 110, 120 grand, they're going to hit that.
Yeah. I think they're looking. I think people who are making over 250 are going to be more affected by this than the $110,000 person.
Well, but here's my point: is once you hit this ceiling of 10,000 just on your state income tax, then the property tax is pretty much gone, right?
Yeah. It's gone.
Yeah. So
that's a negative. That's the negative.
Yeah. So that's one of the impacts, and that's one of the things that again, the California Association of Realtors was really anti with the.
I'd like to make another point too on the state income taxes. A lot of times, taxpayers weren't even allowed. They didn't even get the benefit of the state income tax deduction because of the alternative minimum tax system.
Oh, that's
so. Even though they thought they were deducting it, the AMT kicked in.
How often did that happen?
That happens a lot. People don't realize that's happening. So again, this is sort of a juggling act of how much they're really going to lose on this. A wealthy person will definitely lose on it.
Right.
But somebody maybe in the $100,000 to $250,000 level might not have that much of a hit on it.
Okay. That's a really important point. Yeah. I don't hear anybody talking about that.
Yeah, they complain about the state tax deduction, but they don't realize the alternative minimum tax.
So they weren't getting the benefit.
Yeah, they weren't getting the benefit anyway. So that happens. That's
like
very
at what income level would you say, kind of ballpark, would you say, okay, that the AMT kicked in where that started to happen?
Where it happens probably up to $250,000 a year. Yeah, that happens a lot. So, it definitely happens in that range. Okay. But the individuals start making more than that, they're not going to. They're out of the AMT. They were out of the AMT and they were getting the benefit of the.
But if your income, the AMT was. What was that range that people were having that were getting?
Maybe up to $250,000. These are general comments I'm making. I'm not exactly sure. So everybody needs to really look at when they get their tax prepared this year. They'll probably say, "Wow, did it help or hurt?" And their tax preparer would be able to tell them that because they could look at their prior year return and say, "Okay, were you actually getting the benefit of state tax deduction?" No, you weren't. So that's not a big deal. Don't worry about it.
What percentage of the people do you think were being impacted by the AMT?
A lot.
Half.
Yeah, I'd say half. And half the people probably weren't even able to deduct a benefit from their state income tax deduction to begin with. Wow. So it's not that much of a problem. But those that are making more, it's a real hit. So it depends. So that's one thing you have to talk to your tax advisor about and say, was I really getting that state tax deduction benefit?
Yeah. But no, that's a huge point because a lot of people are moaning, basically saying, "Hey, I lost all this," and the reality is, no, you didn't.
You never had it.
You never had it. So, yeah. Wow. Okay. All right.
Do you want to go back to? Oh, okay.
Okay, we're going to go through a couple examples just to share some of the things that John was talking about. Here's an example of owning versus renting. The single person income of $100,000. Buying a $300,000 home with 4% as an interest rate on their loan with no down payment. And you can see the comparisons there as far as the amount in state income tax. So John, I have just kind of walked through these numbers, and we can talk a little bit about that as far as the state income tax or the state income.
That's the prior law. You got that. You got the state. You got the property.
This is prior
interest. Law. Yeah.
Okay, so you can see the prior law. The tax bracket, and then the $3,413 tax savings. Now we'll go forward. Okay, here's the new law. And the state income tax, it's talking about the property tax, the mortgage interest deduction.
So everything has been eliminated.
Yeah, personal dependent. Okay, then the standard deduction. Here's your tax bracket. Okay. All right, and then, hold on, let me go back. All right, so the tax is at $15,407. And then the tax savings owning versus renting is $3,413, so equals $14,570. So there's the changes there, with on a smaller property. Okay, all right. Now, here's an example of the breakdown of $50,000 in taxable income under the new tax law. Now, here's the point of this and what we're trying to share. The big the biggest point that we're trying to accomplish with the Wealth Academy is retirement is about having retirement income, or what I call alternative income to your job. And the reason I call it alternative as opposed to investment income is most people are so focused, they really focus on two things. Number one thing they focus on is how much am I getting paid on my job? That's the most important thing in their life, is how much am I getting paid? And then the second thing they focus on is how much can I save? But what is not even on the radar screen for the majority of people is, what is my alternative income? And again, I call it alternative income because we need this alternative income from your job. We need to create that income to pay all your bills so you can in fact retire. One source of alternative income is Social Security. So it's not just your traditional retirement income or investment income. But here's an analysis. The majority of the people in this country, and when I say the majority, I'm going to give you an idea of the numbers. In Orange County, 10% of the people own investment real estate or 2 or more properties. In Los Angeles County, it's less. It's 7.5%. Now, here's my point to that. What does that tell you? 90% of the people plus do not see real estate as an investment vehicle or as a retirement option to create this alternative income. It's just not there. What are they looking toward? It's basically, I got to put my money in my 401k, or my IRA. It's an autopilot program, where I'm just, go to work and they take my money and I put the money there. And most people are not putting very much money there. Number one, they're just not able to save very much after they pay their bills. The overwhelming majority, like about 80% of the people, really struggle to save hardly anything. And so there's not very much left. So I call it the save and hope strategy. But I wanted to share with you is, if you look at this, let's say you're relying, your whole strategy is 401k. I got to put as much there. The years go by. Now you're 59 and a half or older, so you can start withdrawing this money. And so we're taking a $50,000 in annual income compared to, you have a rental property or a real estate investment property, and you have the same $50,000 in income. Now, John, why don't you do the breakdown on each column? Talk a little bit about the income tax on the 401k.
Well, on the 401k, if you have investment income of 50,000, you take it out of your 401k, you're going to be taxed at ordinary income rates, right, which is on that slide we're at 25 and 8%. Okay, no long-term capital gain rates, strictly ordinary income rates. When you go over to the real estate side, we have $50,000 of investment, our rental income actually, and then we have depreciation, which shelters the tax effect.
Now, explain how depreciation works as far as how you calculating that.
Well, when you buy a piece of property, you got to capitalize the property for what you paid for it, take out the land portion. So the building portions, actually, we can depreciate that over 27 and a half years if it's a residential property. So you're actually taking the cost of that building and deducting it every year for 27 and a half years.
Okay.
So you get that deduction annually.
Now, someone asked me about...
And it's non-cash. Too.
Right, which is great, right?
Yeah, non-cash. You're not putting cash out for that, and you're getting your deduction.
Yeah, it's just a paper write-off, right?
Yeah, paper write-off.
Now, someone asked me, okay, what about depreciation, and what risks do they have with respect to recapture of depreciation?
Well, when you resell the property, that's when you have recapture. But that comes down the road. By the time you sell the property, it's been it has appreciated. And that's the plan. So it's not that much of an issue.
Okay. All right. And then,
in my eyes.
Yeah. Okay. So what would be, now with respect to, doing, let's say, someone has a home that's a rental and they sell it and they do an exchange on that. Okay. How would that affect it?
Well, yeah. If you have a rental and you want to possibly do a 1031 exchange, you could actually find another rental and then defer the gain. You never pay taxes on it. You have opportunities to defer gains as you grow your real estate investment. Go up the ladder, buy more.
So that's a workaround, basically, right?
Well, it's a great way to defer taxes. Yeah. It's done all the time in the U.S. and that's why real estate is an excellent investment from a tax standpoint, because that's a tax deferral component.
Okay, now let's explain that the new 20% pass.
Yeah, it passed through on a real estate investment. Our rental income, you are eligible for a 20% deduction on the pass through, given certain stipulations.
Right.
But in this case, we would $50,000 of income would allow you the 20% deduction.
Okay.
So that's another deduction we get for the real estate investment.
Okay. So you can see the numbers there. So we have the depreciation deduction that's always been there. Mm-hmm. Now we've added this 20% pass through deduction. So the taxable income is no longer $50,000. So now it's $31,000. So that's been reduced substantially. Then you have your ordinary income tax levels. So the after-tax income. And so down at the bottom, you can see the taxable savings rate between the two. Now here's an important point to look at, is that if you look at that tax savings, that's a lot of money per year. And if you look at that as far as actually impacting what your return on investment is, pushing those numbers up, right?
Right, definitely.
Yeah. So this again, it gets back to what is your alternative income to live on? And see, what's great about this is that with the rental income never runs out. And very often, most people, their investment income on their 401k is insufficient to live on the investment income or the earnings. The earnings are just simply not enough. And in most cases, the plan from the beginning is, because the financial planner, the consumer knows that they simply can't save enough to create enough earnings to live on. The strategy from the beginning, from the get-go, is okay, we'll take whatever earnings and we're going to start withdrawing from our principal, right?
Right.
And you don't want to do that, because what's going to happen to your principal if you keep pulling principal? At some point you're going to run out of money. And that's the other big benefit to the real estate, is that you can start to create this investment income, start receiving. You don't have to wait till 59.5. You can start getting some of that income along the way. So you get the help today. Then when you get to this place where you're living on this, as this investment income grows, it will never run out. But here's my point and why I wanted to share these types of things. What is this going to do? Because the big question, are we in a real estate bubble? Do you think wealthy people know this?
We're all learning. I mean, wealthy people have attorneys, they have accountants that they're going to. I mean, a lot of business owners have to contact their tax professional over this new law to make sure they're getting these benefits, especially the 20% QBI deduction. So
Well, and we're talking about small numbers here, right?
Yeah. They're small. These are small.
These are small. This is small potatoes. This is small peanuts. Okay. Think about this on larger levels, right? On much larger investment levels. We're talking about on this 20% pass through. What kind of income? Who are the people that can benefit from this 20% pass through?
Everyone. I mean, everybody.
At what scale? What size up?
Well, all businesses can potentially benefit from it.
Yeah.
Going all the way up.
So even Apple.
Yeah, Apple's going to benefit from this. Well, they're not a pass through. They're a C corp.
Well, that's true. That's true.
So there's a little different. But a lot of large companies in the United States are pass through entities, and it's really great for small businesses. Any small business is going to be able to benefit from this 20%. Most of them will. So that's the area of the law people. I think everyone needs to focus on to offset some of the negative.
So pretty much every small business is going to benefit, right?
Yes. They should, given the industry they're in. If they're a service industry, then there's limitations on that. Okay. This all depends. So every business owner needs to see their tax professional to make sure, to see them now, to make sure they're in position to take that deduction.
Well, the gigantic operations like Apple and those kinds of companies, they have the benefit they got is their lower corporate tax rate went down, right?
Yeah, they have a lower corporate tax rate, and they're bringing back money at a cheaper rate from overseas.
Right. But just so everybody has a clear picture on how big of operations. Because this isn't just Joe, Mom, and Pop. They're going to benefit from this. As far as what are some of the some other.
Well, everybody benefits, like we're just talking about, from Joe, Mom, and Pop all the way up to Apple.
Yeah.
So it's across the board.
So these these kind of benefits is, when these laws are created, as John said, they do the research and say, okay, how do we take advantage of this? These are big incentives. So this point about, are we in a real estate bubble? This is why we're doing this today. Is this kind of stuff is a game changer. Without this, in my view, without this tax reform, I don't believe we're in a real estate bubble either way. But if you look back to, let's say, the early 90s, if you look at the appreciation of real estate in the early 90s, there was a recession. And if you're old enough to remember, Orange County filed bankruptcy and all of that. Property values kind of flatlined through the early 90s, and there was actually a little bit of a decline, 1%, 2%, 3% for a couple of years there. I think that was possible and maybe even probable before this. But this changes everything. When you incentivize people and wealthy people to get involved, there's a big opportunity here. All right, now, we're not going to spend a lot of time on this, but I wanted to share with you just a couple other comparisons of other winners from the new tax bill here. The QBI, this has to do with real estate developers. And you can see the prior law and salary from an S Corp. So this is someone that you can see it's an S Corp, which anybody can file an S Corp pretty much, right?
Right. You can, you don't even have to be an S Corp to benefit from it.
Okay.
So, this is huge. As you can see, the QBI deduction under the new law is $65,000. So
just so people don't know what the QBI means.
It's 20% deduction. Let's call it a qualified business income, but let's call it the new 20% deduction that businesses get if they qualify.
Okay, so let's kind of walk through this really quickly here as far as this developer on what it was before to what it is now.
Well, before he had no QBI deduction, so that's where that's the main change. Well, personal exemptions change. That's a small amount, but the big difference between the prior and the new law is the fact that he gets a 20% deduction of $65,000, which is based on his salary and wages. He has $130,000 of combined salary and wages, and the new law allows him to take 50% of that as a deduction.
Now let me ask you, as far as for someone to be considered a real estate developer, can Joe Smith say, okay, I'm Joe Smith, real estate developer. I buy houses and fix them up and flip them. Does that qualify for real estate developer?
It sounds like it does. Yeah.
Okay.
Yeah.
Here's my point. To fit into this box of real estate developer is not very hard. Not very hard at all. And there are a lot of you out there that are investing in different ways, that do the flips to get position. Now
remember, the one thing I note that the capital gains or investment income doesn't apply. The 20% doesn't apply to a capital gain type property. It's got to be ordinary income for us to get the 20%.
Okay.
So that's important.
Yeah. Okay. Good distinction there. But look at this big difference. And what my point was is that when you think of developers, a lot of times people think of these mega developers. Not all of them are mega developers. But look at that big difference, that QBI deduction, as John said, the 20%, $65,000. It's a big swing. And so we look at the tax difference. The tax on the left, prior law, $112,000. Tax on the right, $75,000. Big difference in tax change. What does this do? Incentivizes developers. All right, the QBI deduction for real estate professionals. Now, prior law, look at this shift. John, let's talk a little bit about the
prior law. You have $175,000 of income. You have a personal exemption of deduction, a standard deduction. It gave you a taxable income of $164,350. A tax of $38,000. That was the prior law.
So that's what a realtor would have paid.
Yeah, that's what they would have paid. Yes.
Okay. Now let's look at the new law.
Now the new law, you've got that same income. You got the standard deduction, which is $12,000, which she gets as a single taxpayer. And then you get this business income deduction, which is the 20%. And in this case, almost gets all the 20%.
Yeah.
But the fact that her income is actually high, exceeds the $157,000 limitation. I think her taxable income based on that is $163,000.
Okay.
So she exceeds the limitation there. So they're limiting her bonus deduction.
Yeah, okay.
And that's why it's been reduced. She doesn't get exactly
Right.
the 20% is being reduced.
Right.
So we all have to be careful when you're a service provider. You got to look at the limitation. If you make more than $157,000, you're going to get limited on that 20% bonus deduction.
Okay.
So everybody needs to get back to their tax professional and do some planning to make sure they benefit.
But in this, they're going to save basically about $7,400 in taxes.
Yeah, definitely.
Now, here's my point, about sharing this with you, is that this is the real world of how politics works in government with respect to negotiating deals. This deduction, the realtors were impacted with the mortgage interest deduction. This is an offset, and this is the reality of the way the game works, and this is why we need to know how things are changing in any industry with laws as laws change. Our deduction for qualified business income, John, I'll just turn this over to you.
Yeah. I mean, it's basically a non-personal service business. That means they manufacture. Any business that's not a personal business is going to get this deduction. Okay. And it's subject to 50%, or limited to 50% of W-2 wages paid by the business, or 25% plus original cost of the property. So that's basically saying all companies that are not personal services are definitely in play here.
Okay, so, which is a lot, right?
Yeah. I mean, that's what they really want to do. All the manufacturing companies that hire people. Yeah. I mean, it's all these companies have a lot of employees.
Yeah.
They're non-personal, and they are going to get the benefit of this.
Yeah. So again, what does that mean? A lot more income for them, right?
Yeah, a lot more. Yeah, lower taxes.
Yeah, and so again,
hopefully reinvestment.
And this is how we create, the higher wages, which is really that's the solution. We need more and more people to make more money for things to expand, to continue on. All right, deduction for qualified business income.
This talks more about the 20%. Sole proprietors and independent contractors actually benefit from this too. This gets into the fact that brokers, property managers, and agents, these are those businesses, they are personal business. That's a personal business. And if you're a personal business, then there are limitations on whether you can get this 20%. And what that slide's telling us, if you make over $315,000, it starts to phase out as a joint filer. And if you make over $157,000 as a single filer, this 20% is going to be phased out for you.
Right. Okay. All right. Terrific. Okay. All right. Deduction for qualified business income.
I think we went over that already.
Okay.
Yeah, we did.
All right.
We did.
All right. And then we'll start to wrap up here as far as winners and losers. Winners, big businesses, small businesses, developers, realtors, property managers. And who are the losers? Those that don't get in the game and invest. You have to be in the game, and holding it's the number one problem. And we didn't share this slide, but we talk about the slide about the difference between those that control wealth and those that don't. 80% of the people in this country share in 12% of the wealth. I mean, that's a scary number. 80% of the people control 12% of the wealth. So what that means is basically the top 20% are controlling almost all the wealth in this country, and the top 10% control 77% of the wealth. Why? Because they have assets. They're not relying on the save and hope strategy. So I want you to remember some of these two key numbers. 10% of the people control 77% of the wealth. 10% of the people basically have two or more properties. The real estate, very few people look at real estate as a path to wealth, which is just mind-blowing to me. And it shows you the lack of knowledge when it comes to wealth growth, because they're all been trained to get into the save and hope strategy. And the save and hope strategy is save in my 401k. I'll save as much as I can. It'll grow to whatever it is. And then at the end, I'm going to start pulling this money out. I'm going to take whatever earnings. You saw the extra tax levels that you're going to get hit with that. People think they're saving all this tax money, but at the end, they got to pay the full ordinary income tax. It's not enough, so they have to start sucking from their principal, and they start to run out of money. As John mentioned a moment ago, here's the process of what you need to do. Step one is you have to believe. You have to believe in yourself. You have to believe that you can change your life circumstance, that you can advance your life. Step two is what we talked about today, which is knowledge. You start to learn the process and learn the path. And that's what this Wealth Academy is all about. And step three then is you got to meet with somebody like John, for tax planning, like a Wealth Academy advisor. You have to meet with someone to get a custom plan. You have to look at your life circumstance and say, okay, where am I at right now? What are my resources? How do I put the best plan for myself and for my family to accumulate wealth, to accumulate passive income, to accumulate this alternative income so that you can retire permanently? And what's beautiful about all of this is saving money is not part of the equation. If you can save, and I'm all for saving, great. But it's not necessary. We can get there without saving money, but we have to have a plan and get started. All right, thank you, John.
Sure, thank you.
We have some questions.
Okay, we have questions. Awesome. All right,
So we have Robert asking about the 100% deduction, which I'm assuming is the equipment deduction.
Yeah, it's the equipment deduction, yes.
Okay, so the question is like a new or used motorhome for somebody that's in an independent contractor that would use that for their business.
Yeah, and the new law allows used equipment. Before it had to be new.
Okay.
So yeah, it's used it in. So as long as he uses it for his business, then yeah, that's a deduction.
100% deduction.
Yes.
that reminds me, John, about the point you made too. Talk about the heavier vehicles and that.
Oh yeah, well this 100% expensing is great for the SUV business, because now you can buy, as long as you buy a car that's over 6,000 pounds, you can take a full deduction if you're using it 100% for business. So you get a BMW X5, $100,000 BMW X5. If you're using it 100% for business, then you'd be able to deduct that entire amount in year one.
Wow.
No limitations with this expense deductions.
Wow.
Yeah.
Okay.
That's a big deal.
Yeah, it is a big deal.
Yeah, it is. Yeah.
And this is more general. What does John, and I would probably get Mark's feedback on this too. What do you suggest we do to lower our taxes and best take advantage of the new tax laws?
Well, I think you have to start with talking to a tax professional and have them look at your situation. Give your tax professional a call and say, what can I do? They have the knowledge of your tax return. They should be making a call.
Well, to this question, John, what are some of the most common mistakes that you see? Like when you're sitting down with someone, you go, "Whoa, what about this?" And they just don't know. Like, what are some of the things that people overlook? Or just mistakes that people make?
Well, I really can't comment on that. I can't really think of something. I could think of things, but I wouldn't want to comment on that at this point in time.
Okay.
But here's a common mistake. I don't like Schedule C's. I'd rather have somebody be incorporated. I think the audit risk is higher for Schedule C's, and there's a lot of benefits a corporation can provide, possibly S corps or LLCs, asset protection, less audit risk, pension deductions, and stuff like that. So
a lot of people don't file the corporations because they're afraid of it's like, okay, it's going to cost me a few dollars, and
it does. It's true. It does cost you money. It's an $800 minimum tax in the state of California, and it does cost more money to prepare the return. So it really depends where you're at. If you have a business, I think you should really be incorporated.
Yeah, for sure. If you have a business.
Yeah.
But let's say at what income level would someone need to be making to where you say, okay, you really, you need to file a corporation?
At what income level? It really depends. I can't really say what income level. If they're really serious about having a business, they want liability protection. That kind of
to me the liability
protection. Like if you obviously go into real estate, everything's got to go in an LLC.
Yeah, right.
Because for that protection. So that's a good example. From a real estate standpoint, you definitely want to be in an LLC.
Okay. All right, Tripp. Any other questions?
Yeah, no other questions, but just maybe something to further comment on is like in a nutshell, because we've heard a lot of negativity about this new Tax Reform Act, right? So there's been a lot of negative. And I think what Mark's point in all of this was to show kind of the upside of this. So
Right.
can we nutshell, like maybe each one of you comment on nutshell, like what you see ultimately as a long term, just to kind of as a recap to this
Well,
whole
John,
conversation.
On what, on...
Just a big picture on
The
how
big
you see this
picture.
affecting the
Yeah.
economy and the country and people.
Well, yeah, I think overall the Tax Act was, I mean, look at the overseas money that's coming back in the United States. That's a very big positive, and the lower taxes for small businesses, this 20% deduction. If you can get into this 20% deduction, it's going to be extremely helpful overall.
Yeah.
So yeah, lower taxes. I think we're going to expand. We're going to create some jobs, and America's going to have to get back to work. I mean, the whole thought process here is everybody make more money and pay more taxes, and pay more money in wages.
Yeah.
So hopefully this will stimulate that.
Well, and, last thing I'll comment on that is what is the most important factor with respect to the economy is psychology, is what people believe. When 2008, when the market started melting down, why did it melt down so fast? Because fear took over, right? It's the psychology is like, okay, there's a little bit of a problem. You take the stock market takes a little hit, and another one, and then all of a sudden it's like, here we go. We're falling off the cliff. It's the end of the world, and the stocks go down 60%. So much is a herd mentality because of fear, but it works the other way. I'll give you a perfect example. What I'm talking about is Bitcoin. All right, what's the science behind Bitcoin and Bitcoin's valuation going through the roof like it has over the last year? There is no real science to it.
No, I have no idea.
Yeah, there is no science to it.
Makes no sense to me.
It's a belief, it's a psychology that for some people that, hey, Bitcoin's the next big thing and they just are jumping on. But if you ask them to prove earnings and they can't because it hasn't happened. So it's just their belief system. Here's my point on how that ties in is this new tax reform act. There are real quantifiable dollars that lots of people, from small to middle business to large to individuals across, are all going to be getting money that they wouldn't otherwise get. It affects psychology. It definitely will affect the psychology, and we're starting to see, and we've already seen it. Look what's happened, with the Dow. Before this Tax Reform Act, how much did the Dow go up over the last year? The Dow was up about 40% over the last year. Why? Largely psychology. Largely
Definitely.
is people believing, hey, it's going to get better, the economy's going to get better, and so the investors invest based on what they believe things are going to happen.
Mark. Yeah,
what's going to happen next?
Yeah.
That's why this
Less
is so good.
regulation, lower taxes.
Yeah, the psychology is the big X factor change. So those of you that have this psychology of fear saying, it's another bubble, you're going to miss out. You're going to miss out.
Game. You got to be in.
You got to be in the game. Exactly is right. All right. Thank you, everyone.
Thanks,
everyone.
All right.
Just real quick too, we didn't plug John's business whatsoever. So
That's
maybe you
okay.
could just tell us where you're located.
I'm in Corona, California.
Corona. Okay, so John Jackson, Corona, California.
yes.
John is Jon. Right?
Jon,
So
yes,
somebody wants
yes.
to look you up, and we'll make sure that we get a link posted on our
Sure.
site as well.
Okay.
All right.
All right.
Yeah, and if you can obviously Google John, but if you want his email and contact, shoot me an email. You can see my email on there, and then I will connect you directly
Yeah, I'll
with
be
John.
happy to talk to anybody about it. So.
Okay.
Great.
All right.
Okay.
All right. Thanks.
All right.
John. Really
You got
appreciate
it. Okay.